I just want to look at some of the performance, the relative gainers and the relative losers, and actually not one sector.
They're all losers
exactly
today.
It's all a relative game here, but it is some of the users of steel and aluminium at the back end, ultimately, that are seeing.
Yeah, if you look at the Bloomberg here and you slice and dice the S&P 500 into 24 industry groups, the worst performers are autos and components makers, and that is at the bottom here. You can see they're off by 3.8%. Pretty sizable decline given the S&P 500 losing 1.7%.
Cameron.
Well, I think it's clearly a case of shoot first and ask questions later. It's pretty remarkable, really, and when you think that the U.S. equity market at its nadir today had lost something like $550 or $600 billion of market cap. But if you actually look at the amount of steel and aluminum that the U.S. imports, it's peanuts. It's like literally $1.5 billion a month each. So $3 billion a month combined versus imports of $250 billion. So we're talking about a little more than 1% of U.S. imports, and yet we're wiping all this market cap off. And the reason, of course, is it's not just the literal prosaic economic impact, it's the messaging and it's the potential retaliation. And let's face it, I think most people involved in financial markets generally prefer free trade and the free movement of goods and services and capital. So anything that would counter that is seen as a policy mistake. And one thing we know about markets is they don't like a policy mistake. And that's essentially the market's voting with its feet at the moment.
Yeah, we're asking bigger questions about ultimately what this means for NAFTA. I mean, we were talking about the performance that we're seeing in dollar Canada and in dollar Mexico today. It's about more than just aluminium and steel at a time when actually the markets are still pretty jittery, aren't they?
Yeah, I mean, I think that's the other thing, is it comes in a backdrop that is not exactly rosy. And if we were at the ding-dong highs and volatility was low and everyone was happy, maybe people would try out the numbers that I just did and talk about, well, it's not going to really dent earnings for the broader market and we can look forward. But the fact is that people are feeling jittery. We have had a volatility shock, and this is just, if you will, throwing gas on the fire.
You know, it's interesting because we're down for a third straight day. The last time that has happened was back on February 5th. So people were looking for a second shoe to drop, potentially. We didn't know what the catalyst would be because we had a sharp recovery off the initial sell-off in February. And this looks like it's a continuation of that same nervousness. What's changed since the sell-off in the first part of the month?
What, in February? Well, I think people have come to the realization that we're in a brave new world, that the go up a little every day, which was the story of 2017, that doesn't exist anymore. So the S&P 500 moved more than 1% in a day, 12 times last month. It did it 7 times all of 2017. And the irony is that we actually had more 1% up days than down days last month. It's just the magnitude of the down days was so much more than the up days. But it is a higher vol regime.